all of our memories are so short, right? Like, for example, if you have money in the stock market, you're probably upset about the performance the last, 6 weeks. Oh man, I'm down 100 grand or whatever the number is. But what you forgot was, how up were you, right? What's your position right now relative to your cost basis? And the answer is you're probably pretty far up, but you forgot how far up you were, and you're pissed off that you're down a little bit in 6 weeks.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why? Hi everyone, I'm Jason Balara, and this is the Know Your Why podcast. Today I'm here with Jacob Vanderslice. Jacob is the co-founder of Van West Partners and a seasoned real estate investor since 2005. He oversees the creation of self-storage investment for portfolios and leads the investor relations team. So, Jacob, there's a lot more to your bio and a lot of stuff I'm sure we'll touch on, but I always find it's nicer for people to hear it from you. First off, thank you. Thanks for coming on the show today. Appreciate the time that you're here to share with me and my audience. So thanks for being here.
Good to be here. Thanks for having us on.
Yeah, absolutely. Well, let's start with your background, your story, kind of what got you to where you are today, and then we'll dive in.
Yeah, I started investing in real estate full time around 2005, and at the time I was in the fire service, and you only worked 10 days a month. And as a kid in my early 20s, I had a bunch of time on my hands. I started dabbling in single family residential, just kind of fixing up rentals on my days off. Did a couple fix and flips, and we got busy doing that. And I quit my fire job in probably '06, and I guess I've been gainfully unemployed ever since then. So going on 20 years, for better or for worse. For a long time, we did mainly residential investments. We did a ton of volume, probably 1,200 deals all over the country, mainly in Denver. We did some adaptive reuse retail. We did some townhome development, multifamily, industrial. We covered a lot of the real estate food groups over the years. And leading up to 2015, we had been considering getting into the self-storage space. And we liked the fact that it's been historically downside protected. It's got durability. It's got recurring revenue streams. And we did our first project in 2015. And at the time, it wasn't really an intentional fundamental pivot. It was more just, let's try a deal out and see how it goes. And it went okay. So we kind of kept going. And over time, we evolved to being pretty much exclusively self-storage owner-operator. We own 41 self-storage facilities. Those comprise just over 20,000 units, about 3.4 million square feet. We'll occasionally do some development projects, but most of our deals we bought are just value-add existing facilities that are undermanaged. Their rents might be below market. Their expense loads might be above market. They may not have a website. They may not advertise. So we'll identify these inefficiently operated properties. We'll buy them, and we'll add value through what we think is a more effective operational platform. So that's what we're up to.
That's great. Your the timing, you said kind of started around 2006, which most people know in 2008, 2009, 2010 wasn't a great time for to have. Maybe it was a great time to start in real estate, but wasn't a great time to have just gotten into real estate. What was your experience through those years around the Great Recession? Like how did that kind of start in your real estate path? How did that influence, kind of going forward?
Well, we've learned nothing from our successes. We've only learned from our failures. And I think about those days constantly, and it feels like it was just yesterday. But I'm a young buck in my early 20s, and things are working okay. Then suddenly they stop working. And I remember going to the grocery store a few times in '08, wondering if my credit card was going to go through, right? Kind of one of those deals. Yeah. And it was this interesting dichotomy because we were getting beat up on the deals that we had bought prior to the downturn, but we were going to the auctions and we were buying single family homes, 50% of what they traded for a year ago. And it was just the Wild West. And why did that happen? Well, it's crystal clear in the rearview mirror, right? Years later, easy access to credit. There was a big bubble in the market because of easy financing. And there was a massive global downturn because of all that toxic mortgage debt out there. And every time we're doing a deal today in the last 15 years or so, we think about how are we positioning ourselves to weather another storm like that, when and if it comes. But it was a baptism by fire, very educational experience. And again, you don't learn from the successes. Oftentimes, the deals that are home runs, you got lucky on timing. You had some market tailwinds. But the deals that fail, you remember constantly and think about constantly, and you try to apply those lessons to whatever you do. And we're continuing to try to do that. We get a little bit less stupid every year. So 3 months into 25, we're a little less dumb than we were in the same time period 3 months into 24.
Yeah. Yeah. I mean, that really is, it sounds so simplified, I guess, but that really is just take every lesson from, the previous years and try to apply it going forward and get a little less dumb, as you say, about it. I, I've had, I feel like real estate investing comes in waves just like the markets do. And it's been an interesting kind of observation through the podcast, where people that I talked to that have were involved in real estate in some way prior to 2008 have a very, I guess, more informed certainly outlook, but a different way that they've approached and kind of seen what we've gone through recently over these last couple of years. And it's always very interesting to get that perspective from people. I was very minimally involved in real estate at that point, but I was, and I kind of saw both sides. Got a little bit lucky because I sold something, a house I had bought maybe in 2000, and I sold it in 2006, and so got to ride that wave up and then out for a little. But it was I'm just kind of fascinated by people who've been through that, and then how that shaped. You mentioned you've been through a number of different assets in the real estate space and kind of settled on self-storage. Is that related to those experiences? Is it independent? Is it sort of a mix? How did that shape your idea of kind of dialing in on self-storage?
Yeah, we consider ourselves real estate entrepreneurs that happen to own a lot of self-storage. And when and if the self-storage strategy kind of shifts, we'll go to where there's better return, better risk-adjusted return. But high level, the shift in the industry was mainly because of kind of a shift in our philosophy. And our philosophy leading up to going bigger into self-storage was we were being transactional. So we were buying and selling. Often we were buying and selling quickly. And that worked for a while, and it generates cash, but it's tax inefficient, and it's kind of an eat what you kill strategy. So we wanted to shift our thesis and our kind of investment philosophy into, let's focus on buying assets that produce cash flow. Let's finance them responsibly. Let's add value through more efficient operations. And we'll monetize that value creation with the refinance or a sale. But what we don't want to do is go buy a deal, make it better, and sell it a year later, unless it, for some reason, makes sense to. So the shift into storage wasn't necessarily because of the experience we went through in the downturn, years before. It was more of just landing on a strategy that we felt was more durable and more repeatable and more scalable, and arguably more downside protected. And there's been a lot of downside discussion, especially recently, but really the last year or two. And we think the asset class, no doubt, it's gotten some of the headwinds that other real estate asset classes have experienced. You can't escape whatever you're in. You can't escape high interest rates and moderating rent growth. Right. But historically, it's resilient, and we think it's a good blend of kind of downside protection, resilience, but also reasonable and quantifiable upside. And that's a vehicle we landed on, and it's time will tell, right? I'll tell you in 10 years how it went.
Yeah. Yeah, that's another great point, that the especially in real estate and looking at it on the long term, it really is, you don't really know how it's going to work out right now. And it's kind of, as I get, I guess, older and also like more involved on the commercial side of real estate, as I've gotten in that space, it's even more clear how much your view for a long-term horizon matters. And it's almost like it's a funny thing. People put money into their 401k IRA and for whatever reason can not think about it, right? Like, oh, I can't touch that money until I'm 65 or whatever, whatever
It's
the case
house
may
money
be.
to
But
a degree, right? Yeah.
right. But then they make a real estate investment and it's like, oh, panic when and it's like that. But if you think about it the same way, like the intent is for this to be a long-term investment, and over time things will get better. And we just happen to, and this is why I love talking with people that went through the 2008 financial crisis, because if you went through that, then what just happened or maybe is still happening isn't like shocking or even, I don't want to say that people don't worry about it, but it's definitely a different feel from the people that have been through, the downturn 2008 to today's downturn in real estate. And it's different, but not entirely different. And so I just think that what you mentioned about the focus on being, uh, looking at it less transactionally. And it's like, there's a lot of people that made quite a bit of money between probably, 2018 and early 2022 if the timing was exactly right. But then at the same time, that wasn't necessarily because of operational excellence. And I think if you look at it from that long term, now you've got to really focus on operational excellence so that you can take advantage of those good, really good markets, but also like survive and maybe even thrive when it's a bit of a downturn.
I want to latch on to a moment for a comment you just made on timing. And, you look at pitch decks from investment managers that show their crazy returns they put up. Look at this deal, look at this multiple, look at this IRR.
Yep.
And a lot of those were realized in, for example, 21, early 22.
Yep.
And what's interesting is that those returns were not unique to that shop. Everybody was doing the same thing.
Right.
It was not everybody, but most people. It was the perfect storm of compressing cap rates, rising rents, and an historically low cost of capital on the debt side. And you pour all that fuel on the fire at the same time, you're going to have insane home price appreciation. You're going to have insane multifamily valuation increases. And then once that kind of moderates, it's a different world. So when you talk about track record, and if you're interviewing a sponsor you might be considering investing with, understanding their track record obviously matters, but I think understanding the when on that track record is so much more important. When did you do that? Mm-hmm. When did you buy it? When did you sell it? Oh, we bought it in 18 and we sold it in 21. Well, good job, but maybe you're a good operator, you know what you're doing, but you definitely caught some tailwinds there. Right. And where I think we're seeing a cleansing happening here is deals that were bought in 21 and 22, and they're starting to kind of reach the midpoint of their life cycle. How are those deals going? How are you navigating this new environment? How are you navigating debt maturities and a lack of pricing discovery, a lack of trades, a moderation in rent growth? So timing is everything. And for people who might have sold their multifamily portfolio in late 21, they didn't know what was coming up, right? In mid to late 22, they didn't know how much the world was going to change. They just figured, oh, it's going to get good valuation. Let's make a good return. Let's get out. Right. And the timing of track record, I think, matters a lot more these days than the actual track record itself.
Yeah, no, and I mean, good for people that were able to take advantage of it on, getting out at the right time. And I'm sure some people did, sort of recognize, maybe they didn't know exactly what was going to happen, but recognized, hey, I probably never get these valuations again. I might as well just, take my profits and kind of reset. The interesting thing is I like that you said that, we're kind of in that mid cycle. And I mean, to be clear, like, we bought in 21 and 22, and we've had a lot of struggles with those deals. It just, it is what it, but it's like, you just figure it, you either figure it out or you don't, right? It's like,
Yeah,
you either
yeah,
figure it out or you're out. And I think that it's what might be nice out of this is, in a whoever 2 5 years, something in that range, it's going to be clear to see who is able to survive it because of operational excellence. And I think that'll be, really a good demonstration of track record is what did you do when it was hard. um,
yeah. You talk about survival, and January of 24, we were sitting here, and this is not unique to us, but the one liner theme was survive to 25,
yeah,
right?
yeah,
I was sitting here probably on a podcast or a Zoom call saying, tell you what, in 25, things are going to be better. Interest rates are going to be moderating back down aggressively. Sentiment's going to improve. Things will have stabilized. And like all my forward-looking statements, sometimes I get them right, but it's purely lucky. Like all of them, though, I was wrong. Here we are at the end of Q1 in 25, and it's not getting any easier. And some might argue it's, to a degree, could be getting harder. Right?
yeah,
That interest rate relief is not on the horizon. There's some potential moderation in the 30-year fix based on the direction the 10-year Treasury is going, but we're not going back to 3% rates anytime in the foreseeable future if we ever do again. The federal funds rate, if you looked at the kind of the forward curve, the Harry chart, the dot plot a year ago, the forecast was that the federal funds rate was going to be a lot lower today than it actually is.
right,
And now the market's thinking, all right, maybe two rate cuts, maybe one, maybe zero. Who knows? Like the surveys are so variable with the FOMC. So, like always, nobody can predict the future, but I would say that the outlook now is more opaque than it's ever been, just given how wrong all the predictions were a year ago relative to what's actually happening today. So time will tell.
yeah, yeah. And I don't consider myself an economist and an expert in all of that, and but I do like to listen to people that I think are looked at as sort of um, economically savvy and understanding how it all works. And man, I've seen a lot of wrong predictions, and it just, and like, okay, that's fine. Like, it just sort of showed me that the predictions don't matter. Like, it really does not matter that people thought rates were going to come down faster. That people thought. I mean, in 2021, I was at one of the large real estate conferences, and there was a panel on, sort of what to expect. At that point, everything was really great. It's like early 2021, things were picking up, and it was like, oh, interest rates are going to be zero. Like, we're gonna have 0%. Like, it was the way it was presented was not even like, this could possibly happen. Like, this is definitely what's going to happen. We're going to go to zero interest rates. And that wasn't the only place I heard that prediction happen. And it couldn't have been more wrong. And then that same panel, a year or 2 years later, is like arguing the other side. And I'm like, it's just, I mean, you take what's in front of you. This is not, I'm not disparaging the people on the panel. They're much smarter than me. I'm saying even the really smart people that study and try to figure all this stuff out, you don't really know. I My personal feeling is that a lot of the financial levers that we have to pull at a macro level, and the strategies don't actually even apply to today's day and age. But people say, historically we did this, historically it looked like this. And I'm like, well, historically we didn't have social media that could tank a bank in a day. Like, there
Yeah,
are things that didn't exist then. And so making these decisions based on what used to happen 30, 40 years ago, or even in 2008, like, that's where I'm like, that doesn't make a whole lot of sense to me. But again,
so
I
two
don't
two
make those rules. I don't claim to even understand all of it, but I'm just like, I don't think you can act the same way now that we did the last time we dealt with this problem. Like it
Yeah,
just,
and a couple comments there briefly, and no offense, but simpletons like you and I, right? We have our forward-looking statements, and all the way up to like senior policymakers. So
yeah.
Ben Bernanke in 2007 was quoted as saying, "Housing is headed for a soft landing." Right, Chairman of the Federal Reserve.
Hmm.
Janet Yellen in 2021 was quoted as saying the proverbial inflation is transitory. Right, here we are. So even the people at the top don't know any better than you and I do as we sit here in our offices today. And secondly, just to dive in on another comment you made, I'm a big student of history. I read almost exclusively historic and nonfiction. Very few business books. I read about leadership and a lot of war books, and I try to think about, okay, what's happened in the past and how can you apply that to what's happening now and what's happening in the future. And to your point a moment ago, we are less and less able to do that given how rapidly the world has changed.
Hmm.
I'm gonna rabbit hole for a minute here, so just indulge me if you would. I'll
Yeah,
try
no,
to.
please.
All right, think about the peasant back in 1200, right? It's the medieval period. That guy's plowing the field. He's got a cart and a horse. He's probably had 3 or 4 kids, and maybe one of them survived to like being 5 years old. That guy's probably going to die when he's 40 if he's lucky, right? And just have a miserable life. Fast forward 200 or 300 years, go to 1500. All right, the Enlightenment's kicking off, but that guy's still in a cart and a horse, and he's still plowing the field, right? His life's not that much different. And then go further, even more so, go 500 years into the future. You've got the Industrial Revolution kicking off in the early 1800s. It starts in London, it kind of spreads around the world. People start shifting from being a more agrarian society to moving to cities. They're working in factories, they're working in production. Life was still pretty miserable, though. And you think about the first heavier than air flight in the early 1900s, the Wright brothers. Within about 65 years, we were on the moon, right? And then think about fax machines in the 70s, and think about the internet starting up in the early 2000s, and think about how much has changed in the last 10 years.
Right.
And from a technology perspective, from an access to information perspective, you can't go back and say, oh, the RTC crisis in the 80s, right? The market reacted this way.
Yeah.
And make inferences on what the market's going to do today, because the access to information is real time. Everyone can see the same data and the same information and react quickly. So I think that downturns, as we look forward into the future, are going to be less lengthy and less pronounced because things are so efficient, right? Capitalism's gonna make that downturn more efficient and course correct faster than it has historically because of that access to information. So you can't say that the GFC, right? Not too long ago, you can't say that what precipitated that. If the same thing precipitates another crisis, you can't infer the market's going to react in the same way. It's kind of uncharted territory now. And if you read the AI soothsayers, we're doing a bunch with AI in our business. One of my partners thinks that there may not be jobs in 10 years, right? Because computers are going to do everything. How's the economy going to react to that? So said otherwise, all we can do is make good decisions with the knowledge that we have at our fingertips today, try to protect downside, try to make reasonable, achievable assumptions if we're buying a deal or making an investment, be conservative with our leverage, and just try to operate, right? You can't control where rates are going to go. You can't control when and if a downturn is going to come, but to a degree, you can position yourself to weather that as much as possible. But less and less these days, you can't do that by looking at the past and making inferences on what's going to happen today and in the future for all the reasons we just talked about.
Yeah. Yeah. I completely, I said much better than I have said it, but it, that's exactly, I mean, it's just like, it's funny. People love to use technology and, we all, most everybody I think has a smartphone at this point. And I would argue that part of the reason why, just if you say commercial real estate, this could apply to a lot of things, but part of the reason why commercial real estate has gotten maybe more popular and more accessible is because of technology, because you can do so much from your smartphone. Well, the iPhone came out in 2007. So we don't have, it's not like we have like to your point, like we don't have a lot of time of being able to operate a business from your hand. That's
Yep.
not that's not like a historical norm. And so understanding what and I mean in social media, even even farther beyond that, where like I said, everybody knows what's happening already all the time. Like every you can find out pretty much, and AI is going to make that even faster and more accessible. Like you can go ask ChatGPT a question, like what, ask ChatGPT where do you think interest rates are going, and you'll get an answer. It may or may not be right, but you'll get an answer, and it will be compiled of not data from 50, 60, even 30 years ago. It'll be based on what current data is out there, and so anyone can do that, and it's just I think you're absolutely right. Like we just have to control the controllable.
Yeah,
And
wealth is created during times of inefficiency and dislocation and volatility, right? And I think the peaks to troughs and that volatility and inefficiency are going to be continuing to narrow as we look forward into future years.
yeah,
Again, because of that access to information, and it's a head scratcher for those of us who are real estate investment managers on kind of making business decisions, when to buy, how much to pay, and that secret deal that you might be able to steal 20 years ago because no one knew about it is to a degree kind of out the window, right?
yeah,
Because everyone's got access to the same info. Even our older self storage facility sellers understand what values you're doing. They understand what cap rates you're doing. There's less inefficiency in the marketplace, both in public equities and private and public real estate. So it's an interesting kind of formulation of your thesis looking forward, knowing then that inefficiency is going to be not what it was historically.
yeah. Well, with that in mind, you talked about sort of some of the things that are appealing about self storage, and I think you mentioned what I mean. Some of the metrics that people use when they talk about like getting into a mom and pop industry because there's meat on the bone and we can get those deals that still have a lot of operational inefficiencies and things like that. And I know self storage. Uh, be, I feel like it got more popular, kind of as prices in multifamily rose, then people shifted into self storage, and then self storage prices rose. Do you still feel like that there's still that like mom and pop type of accessible deal in the self storage world? It sounded like kind of from your description that you do that's still a part of your like thesis and business plan.
Yeah, I like to talk out both sides of my mouth here. I just got done talking about how efficient the markets become and how it's more difficult to uncover kind of hidden value. With that being said, though, no matter how efficient the market might get, there's always going to be something out there that's undervalued. It's just going to be harder to find. They're somewhere, I mean, whether it's a rising market or a declining market, no matter how bad or good things might get, there's always an asset to buy to go out and create value. There's always a story there, whether it's apartment buildings or industrial deals or self storage. Um, Specifically, the self storage industry, it's still, despite the consolidation and the entrance of kind of new operators and new capital in the space in the last 5 years, it's still very disjointed and fragmented. I think over 70% roughly of storage facilities in the US are owned by onesie twosie owners. And I'm not suggesting they don't know what they're doing, but often they've owned it for a while, their occupancy's high, they've got a low basis, and they kind of get soft on their revenue management and on value creation because they're making enough money every month and covers their overhead, and they're not going to rock the boat. So they're still out there, but finding those is challenging. I think last year we looked at about 900 acquisition opportunities, and we financially modeled roughly 250 of them, and we bought four. So that's a very wide funnel at the top and very narrow at the bottom. And we're not seeing deal flow in an obvious way start to shake loose, but we are finding acquisition opportunities that meet our risk adjusted return requirements. And those are opportunities for different reasons. But typically, it's it's a lack of efficiency, despite how efficient the market's kind of becoming. So they're still out there, and they're still out there in multifamily. If you look at some of the valuation publications out there, like Yardi Matrix, for example, Green Street, they have a lot of different real estate value and kind of macroeconomic reports that are pretty interesting. Look them up, because they're, you can read them fast, you can read them slow, but they're valuable. And if you look at values from a kind of peak valuation to today perspective, multifamily values and self storage values have, on a macro level, declined just over 20%. So when I say that, though, you think, oh, well, it's not good. All of our memories are so short, right? Like, for example, if you have money in the stock market, you're probably upset about the performance the last, 6 weeks. Oh man, I'm down 100 grand or whatever the number is. But what you forgot was, how up were you, right? What's your position right now relative to your cost basis? And the answer is you're probably pretty far up, but you forgot how far up you were, and you're pissed off that you're down a little bit in 6 weeks. So you've seen value declines that are, somewhat measurable. But what you're forgetting is that, man, there was a big run up leading to that sort of moderation, and you're still, depending on when you bought it, you're still up. You're just not as up as you were, a year ago, and that's kind of easy to forget sometimes.
Yeah. Yeah, no, that's a great point. And I think that we talked about, the influence of technology and access to information and all of that. And it's interesting because to me that's almost, maybe not almost, like that's the skill now, right? Like if it's a marketed deal, it probably, like, everybody's going to see it. But the funny thing is, I'm sure you get this too, but I mean, I get emails from brokers and they're like, this is an off market deal. I'm like,
Air
no,
quotes.
right. I'm like, notice
Yeah.
it. You didn't only send this email to me. Like, this is obviously a like form email. I've seen online marketplaces for uh, uh, purchasing real estate or business, and it's like you pay to upgrade, and you can get access to off market deals. That's not off market. If it's on your website, it's not off market. Like, anybody can pay that fee and get access to that deal. Like, I would guess that, like, the real opportunity here is in the deal finding. Like,
Yeah,
that's
most of we're careful when we use the term off market for the same reasons you just described. If it's a deal that's widely marketed, we can rarely compete, even in this environment. Somebody out there is going to pay more. Their return targets are lower than ours. They're going to get more aggressive on their rent and NOI growth assumptions. About 65% of the deals we've sourced have been true blue off market deals. And the balance of the deals we've sourced sometimes have been widely marketed, but by and large have been inefficiently marketed. Like, someone's got a cousin who's a Remax broker, and they put their
yeah.
storage facilities in the residential MLS for sale, for example. But we get those off market deals through broker relationships, and they bring them to us because we typically perform. We do what we say we're going to do. They'll give us pricing guidance. Hey, my guy wants this much money. Can you do it? And we'll say either yes or no, but we can do it for this much. Go under LOI, then we close. So those are out there, and we've sold a number of our deals off market as well.
Mhm.
And maybe we missed a little bit on value because maybe there was somebody out there who would pay more. But if you get to a value that makes sense for your return, and we have an idea of what our deals are worth as much as you do, with or without a broker or an appraiser telling us. If you get a price that makes sense, it makes sense to transact off market. So a lot of the sellers will buy from, well, okay, I'm in this pretty deep, and 10 million is a good day for me. I can retire and I can be done, and it's a good deal for us. So yeah, they are off market for the most part, but sometimes we'll discover, just like you mentioned, that an off market deal has been shocked to everybody in the industry, even though
Yeah.
it's not listed on CoStar. So you got to be careful.
Yeah. That term definitely gets used loosely, I think, in a lot of examples. One thing you mentioned, kind of those owners that you're buying from, and that they haven't pushed it on rents. They're kind of comfortable in the way that it is, and I think something that has maybe gets overlooked, maybe not by yourself, but I think, like, maybe in generally limited partners and investors, and sometimes even on the seller side, is part of the reason they can do that. Probably the main reason they can do that is they don't have debt on these assets, and so we see that we're in looking in business acquisitions, and it's the same thing. Like a lot of people, if they've owned the asset for a long time, whether they built a business from startup, or they got this mobile home park or self storage building or whatever, some asset, and they don't have any debt on it, there's a lot less reason to rock the boat. And then we come in as investors, and we're going to have 60, 70, maybe more percent leverage. So now there's sort of this minimum threshold of money that has to be generated. And so that's, I think that is maybe the biggest piece of the puzzle in terms of like the disconnect between perhaps where sellers see prices should be, and also like investors don't understand, like, well, why don't you just lower the rents then if there's occupancy's bad or whatever. It's like, well, there's a, there's a strategy behind all of this that is largely dependent on the debt burden of that asset. And so I just, is that, do you think I'm off base there? Like, what are your thoughts on that?
No, it definitely makes sense, and it's surprising how many deals out there are free and clear, right? My deals are not free and clear. I mean, the boots on my feet right now are probably financed, in some way. We don't have the luxury of being entirely debt free, but there's a lot of sellers out there who have owned their deals for a while. And I'll tell you, it's been interesting because some years ago, a seller carry, which those of us listening have probably heard of these, but it's where the seller will finance part of the purchase with a loan. Those were not unheard of, but much fewer and further between some years ago. And they're a lot more common now. And we've gotten a few deals done recently, and we have one in our pipeline. It's a seller carry deal. And it's a 65% loan to cost. The rate's 4.5% fixed for 10 years. And the seller wins because they get an annuity and a tax deferral, and we win because we lock in long-term financing. So we're seeing a lot more of those out there. And we've even gone so far as to submit letters of intent with two different prices. One is a price with a seller carry, and a price that is just buying it outright with our own financing. And obviously the seller carry price is higher, and they see that number and they typically say, "Oh, I'll go with that one. You're going to pay me more money." And it works on both sides. So we're seeing that a lot more frequently than we used to. As we try to source deals and kind of profile deals, again, it's been moderately surprising how many fairly large deals out there are unlevered and debt free, and that gives you a lot more creativity and flexibility and deal structuring to kind of come to a meeting point in the middle where it makes sense for both sides.
Yeah, yeah, I think that's one of the maybe funnest parts about this type of economic cycle that we're in, is the creativity that it is needed. Really, I don't even think it's like optional at this point. Some of the creativity that's needed to get deals done, and not, to be clear, not creative underwriting where you're just there was probably some creative underwriting happening when anybody could get debt at 80-90%. The point is creative deal structure where sellers are carrying some of the financing. Maybe they get to keep some equity for whatever, like some way
Sure.
to make it work for both sides and still get a deal done. And those things are I really actually enjoy hearing like what people do, some of the solutions that people come to make deals still happen in this environment where like everybody can be a winner in that scenario. So it's a pretty interesting time. And if I think if you can kind of get past feeling sad that some money has been lost and it's hard and all of that, like there's a lot of opportunity to be had, and a chance to kind of exercise your brain on how to make it work. So it's a
That
pretty
creativity
interesting
is
cycle.
it's a testament to the resilience of the American entrepreneur. And you might see articles and see headlines about the debt maturity wall, right? All these floating rate loans and how much pain there could be coming up
Yeah.
this year. Well, those headlines were starting in 22, and then look at 23, right? There was some pain, but not macro pain. Same thing with 24. I'm not diminishing the risk out there of these debt maturities, but inevitably what the market does is it gets creative. Banks get creative, borrowers get creative, buyers and sellers get more creative. And sometimes that creativity can help the larger macro market navigate what otherwise would have been a downturn into the proverbial, I hate using this phrase again, but the proverbial soft landing, right?
Right.
So I think that creativity is going to continue in this unknown environment. Again, future's never been more opaque than it has been as of late, but deals are still getting done, and they're getting done more frequently with unconventional structuring methods, like what we just talked about.
Yeah, I think that's a great point. Jacob, let me make sure I get the chance to ask you some of the questions I ask every guest, and the first one is based on the name of the show. It's Know Your Why, and so I always like to understand, kind of the why behind the success. People, you've got a background of multiple different asset types. You've been in the game for a while, and I think that's probably your why has evolved over time. But tell us a little bit about kind of what motivates you at this point.
Yeah, well, like a lot of us are, I'm a deal junkie. I love deals. If somebody even brings up a deal passively at a happy hour or something, it's like crack to me. I have to know the details. Tell me about, what are you planning on doing? So looking at deals and understanding deals, underwriting deals is a lot of fun. It's stimulating. And, leading up to a closing, you're about to close on a deal. You've got your model, you've got your capital raised, you've got your debt financing in place, and you've got this promise and this dream of execution, right? Here we go. This is what we thought we were going to do. We're about to buy it. We better do it. And then watching that unfold during the years of your ownership period and just learning how wrong you are, right? In both directions. You're wrong in the wrong way and wrong in the right way, but deals never go like the spreadsheet says it will, right? And sometimes why they go better or worse. And frankly, sometimes you can't figure it out. Sometimes you can't figure out why a deal was such a home run. Oh man, I wasn't expecting this. And then sometimes the home run deals you buy that appear to be that way in the model are the ones that underperform and struggle. So that, the dream of leading up to the new acquisition and just looking in the rearview mirror quarter by quarter, seeing kind of what happened versus what you thought was going to happen is fascinating. But beyond that, though, on the why, everyone talks about wealth creation, right? What is the definition of wealth? It's so subjective and variable. Sometimes people will say wealth is net worth. Oh, I want to get to 10 million in net worth. Well, net worth to a degree is meaningless unless it's paying you on a current basis. Mm-hmm. And one of my big financial whys, I guess, in this business is durable recurring cash flow. And to me, that's the definition of wealth, just income that's generated monthly, quarterly, that's reliable, repeatable. Wealth to me is not net worth unless that net worth is paying you. And I think that income component is really important. And I guess the last component of my why is I've been so far very unsuccessful in balancing the proverbial live and work, right? Just at the office all day, traveling to conferences, but as we kind of evolve in our careers and continue building our asset base incrementally, I see a path to kind of better balance there as those durable recurring revenue streams incrementally increase over time. But the thrill of the chase, the deal underwriting, the operations, the team we have an amazing team of almost 90 people out there executing our strategy, from our on-site managers to our general counsel. And there's a lot of whys there, but there's a couple flavors for you, I guess.
Yeah, well, that's great. That's great. When people hear this and they want to connect, what's the best way for them to reach you?
Yeah, always love to talk shop about real estate. People can email me, jacob@vanwestpartners.com. Go to our website, vanwestpartners.com, or hit me on LinkedIn, Jacob Vanderslice.
We'll get all of that in the show notes. This has been a fascinating conversation. I appreciate everything that you shared, your insights and kind of perspective on the market in general and self-storage story. So thank you for being here today, Jacob. I appreciate it.
Thanks for having us on, Jason. It was a blast, and here's to moderating interest rates and improved sentiment in 25.
Yeah. It's hard to put that into a catchy slogan, but it's the survive to 25 thing. I don't know that it's we're still early, but I don't know that it worked out exactly as
we all survived. We're
right, surviving, and hopefully now we can thrive. But thanks again for being here, and folks listening. I know you're going to get a ton out of this episode. Make sure you connect with Jacob, and please like, rate, and review the show so we can continue to get more great guests. As always, thank you for listening.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?